Mortgage insurance is a critical part of the mortgage industry that is often misunderstood by customers when they see a mortgage insurance payment factored into their monthly mortgage note. It is at this point that most people find themselves asking two very simple questions. What is mortgage insurance, and why do I have to pay it? Let's start with the first question. What is mortgage insurance? Mortgage insurance is a safety net for lenders that helps protect against borrowers that fail to make payments or default on their mortgages. Every time a loan is made, the risk associated with that loan is calculated. That is where qualification ratios and guidelines come into play. In order to help lower those risks, mortgage insurance is paid, thus allowing the lender to make a loan that may not otherwise be available. Lower risks for lenders means more homeowners and a more stable market, which can also help with lower interest rates. Okay, so let's get to the next question, which is, why do I have to pay it? Well, it all depends really. The reasons you have to pay it are the same reasons that mortgage insurance was created in the first place, to lower risks to lenders. What you're really asking is there a way to not pay mortgage insurance? And the answer is yes. There are actually cases where you don't have to pay mortgage insurance. Mortgage insurance requirements vary from loan program to loan program. So let's examine the top 4. If you are getting a conventional loan and have enough money to make a 20% down payment, then you will not have to pay mortgage insurance. With conventional loans, you are only required to have a 5% down payment, but you can put down as much as you like. If you have the funds to put down 20%, you will not pay a dime towards mortgage insurance. If you don't have that kind of money saved up, it's okay. One of the perks of having a conventional loan is that your mortgage insurance will eventually drop off. With conventional loans, your mortgage insurance is paid to a private company, and after you've reached a certain amount of equity in your home, the mortgage insurance will no longer be added to your monthly payment. It is generally accepted that once you have reached 78% equity in your home, your mortgage insurance will drop off. In some cases, your lender may drop mortgage insurance once you reach 80% equity, if you request it. Just keep track of your mortgage statement and balance to see where you're at. With FHA loans, your mortgage insurance is paid to the Federal Housing Administration, and it is required across the board. It wasn't always the case, but changes in the lending world have caused many FHA loans to carry mortgage insurance for the life of the loan. So, no matter how much money you put down for a down payment, you will have mortgage insurance. This comes in the form of an upfront mortgage payment paid at the time of the closing of your loan, and as a monthly payment, factored into your mortgage statement. If you wish, you can factor the upfront fee into the loan, but it will increase your overall loan amount. VA loans, which are loans for current members of the armed forces and veterans, do not have mortgage insurance either. They have what is called a VA guarantee, which replaces mortgage insurance. There is an upfront funding fee, however, and that varies based on factors such as disability status, amount of down payment, and type of military service, just to name a few. The USDA loan program functions similarly to the FHA program in regards to mortgage insurance. There is an upfront fee and a monthly fee. Again, just like the FHA program, if you wish, you can roll the upfront fee into the overall loan amount. If you're interested in what loan program and mortgage insurance best suits your needs, please contact Open Mortgage today. Thank you.